Hello, everyone, and welcome to our Wealth Builders webinar series. Today, we are going to be talking about inflation and real estate, some considerations as well as opportunities and concerns that clients are often bringing up that we're talking about in a lot of one-on-one sessions. We'll get into first an overall market update. Before that, though, we are going to share a little about who we are. Just for those that are new on the call or clients that have signed up recently, we'll do a quick recap of how we work. We'll talk about what we're seeing in the market, key dates you'll want to be aware of, as well as how we personally approach tax finance in accounting in what we call our on-ramp toolkit. So that's essentially the framework for how we incorporate trends, things in the news, into what we actually do as a strategy. At the end of the day, every strategy should inspire or encourage us to take some kind of actual action. We'll talk about how we do that, and then we will talk, as marketed, about inflation. There we'll talk a little bit about key trends that we're seeing, threats, and then answering the question, is real estate a hedge, or what are some hedges in the event of an inflationary environment? Before we get started, just a disclaimer that we need to make very clear. This is us going over general trends, strategies from a very high 30,000 foot bird's eye view. Anything shared here really should be discussed on a one-on-one basis, as there are always exceptions, and those exceptions can be you. With that, I'm going to hand it over to Sean to go over announcements and team information.
Hey, Miguel, thank you so much for the intro there. Hope everyone's having a great day. Before we get into the webinar, I just want to make some company-wide announcements. So for our on-ramp and retainer clients, we're currently wrapping up our Q3 planning meetings. If you haven't had one scheduled yet, reach out to me or your advisor, and we'll get you on the calendar as soon as we can. We're also going to start our Q4 year-end planning. That's going to start on Monday, the 18th of October. We're going to do that through November 23rd, right before we shut down for Thanksgiving. So if you guys haven't had either a Q3, please get that scheduled. And then, of course, let's try to find some time to get our Q4s on the calendar as well after the 18th of October. Additionally, the estimated taxes for Q3 are due September 15th. So you should be able to check your tax return for an estimated payment on that particular schedule. The payment should be made to true up tax liability for the 1st of this year through the 31st of October. And it should meet the 90% rule. Additionally, the PPP forgiveness. So you have until 10 months after the last day of the covered period before having to make loan payments. So make sure that you're up to date with however that applies to you. And then for our internal deadlines for tax filing, Friday, October 1st is the last day to file personal and corporate returns. So make sure you have that marked on your calendar. Additionally, just some features that we've had. We've been on Wall Street Journal, Reuters, Sherpa Share. So if you ever see us, let us know. Please check out our articles, and you can find out some more information on not only the firm, but just some strategies we're applying to all of our clients. For our tax team. So these are our advisors. You might recognize some of the names here. I'm the second to the right. Carla is one of our tax managers and consultants. Mike, who is the second from the left, he is on our consulting tax rejections. So you retainer clients, I'm sure you've worked with him quite a bit. And Tina on the far right is our bookkeeper. So any bookkeeping related engagements, you guys would be working with her. For our lines of service. So a lot of you guys probably are already aware of this, but just to review, we have compliance and controversy, reporting and diagnostics, strategy, advising, and commercial real estate. So within those, kind of big buckets, we have a lot of different little things that we can do for our clients. So if you have a particular issue, chances are we can't address it. Just let us know. You can reach out to either me or your advisor via email, and we can talk about what you have going on and how we can fix it. So the locations of our team. So we have four regions in the U.S. This is how it's all covered. Each of the members of the team tends to cover a particular area, but really it doesn't affect what you guys are doing too much. We will connect you with the advisor that is most knowledgeable of your particular region. So now on to our market update. We have some trends coming in. Most notably, a lot of tax changes. So if you see anything that would concern you on this list, please reach out to your advisor and we can see how we can adjust for it. Taxes look like they're going to be going up pretty significantly, and we need to plan for this or else you're going to get caught with your head in the ground. So definitely something that we want to keep up with. And again, let us know if any of this pertains to you, and we can hop on a call and talk. Next, we want to talk a little bit about our on-ramp toolkit.
All right, and I'll explain a little here about how we work. I think it's important that anytime we look at things in the news, we want to make sure, well, number one, is this interesting? Number two, does this apply to me? And number three, what action can I or should I be taking? And the reason that we like to structure things within three key categories is because each one will have different set of prescriptive action steps. Number one is taxes. And when it comes to taxes, at the end of the day, if you forget everything else that we've talked about today, what we should understand is how to use business losses strategically, but also how to balance profits and tax savings. Because at the end of the day, for those of us that have recently bought real estate or gone out for a loan or applied for financing for business purposes, you know that you've got to hand over those tax returns. So what you don't want to be is you don't want to be in a situation where you've had a year of huge, giant losses, you got a big tax refund in a period where you're also applying for a loan in the same year, because what's going to happen is your lendability is going to take a hit. So using tax write-offs strategically in a balanced way is what really we get to when we're doing things like tax projections, because what you also don't want to become a victim of is you want to become a victim of making decisions in the past. I mean, oftentimes we're filing taxes multiple months after the year's closed. Well, that doesn't lend itself very well to planning the future, because if you're always closing out the prior year, you're not going to be able to make the key decisions that are going to change the tax picture in the current year. So projecting out taxes and understanding how to balance is really important. Accounting, we try and be very practical when it comes to our clients. Oftentimes we recognize that you're not going to have a controller, an in-house CFO, and even if you have an accounting background, how you do it at a small business level efficiently and cost effectively is usually one of the most challenging things that we need to figure out. Because if you are getting into a position where you're doing accounting again for the past and you've got a whole year of accounting to do, it's very difficult, very different than when you start a business and making sure that you've got things like the right chart of accounts, you've got the right business banking account set up so things are separated. You can get really granular with this. Again, I think our philosophy is that a stitch in time saves nine. So the kinds of conversations we have around accounting are going to be how do we allocate between an operating account and the profit account and a tax account. Idea being that you are splitting from revenue what you would save for taxes, what you would save to pay yourself, so that you don't end up in a position where you have no idea what happened. You've got some money in the bank, and then when you do your taxes, you find out that you owe more than what's in the bank. That's not the picture that we want. And conversely, if you are running a business, you should be aware of the return on investment. The ROI on a business after taxes is the most important number that we look at. So oftentimes when we think about Airbnb, it's great to have an asset, it's great to have income producing. Well, what makes it an amazing tax strategy is that cash flow comes in tax-free. So not only are you generating revenue, but you've got depreciation from an asset, if you're an owner, that is going to offset any type of taxable income for years to come. So again, setting up the accounting, knowing the tax so that you can understand ROI is really what we're working towards, but not something you can really work towards until you've got a pretty good picture of the accounting and tax. That feeds right into our capital allocation strategy. So back to ROI, if you know that you can make a tax efficient return on Airbnb versus parking it into a bond, well, the rational decision is to pick the one with the highest ROI. Now, we also need to talk about allocation and diversification. It doesn't always make sense to just do the best, highest ROI plan because there's a lot of embedded risk in doing something like that. So oftentimes we're trying to get a sense of our clients, what's really important to them, how important it is to think about retirement, for example. So sometimes if you have a profitable Schedule C business, there are some tax savings in putting money into something like a SEP IRA, things of that nature. And at the end of the day, too, we really have to understand how much cash the business needs and eats. In a different life, when we did corporate strategy, we would often talk about discounted cash flows and projecting out what's there. And that's going to be based on an understanding of what costs are over the next 12-month period. So again, we don't want to overcomplicate how we work through things, but we do want to use these principles as building blocks and as tools that when we make a decision of standing up another unit or acquiring another vehicle for a Turo business, or perhaps even starting a consulting side business on top of everything, we want to be first aware of, could this cash be used somewhere else? Oftentimes for our younger clients, we're talking about how to diversify, because we get some founders who are real fired up, very focused on creating one business, and then they do that for 5 years with great success and realize that they don't own any real estate. They have a business with a huge key man discount, meaning if they step away, the business is worth zero, right? So these are just things that you want to zoom out on and really think through. Am I creating a cash cow? And then once I do have a cash cow, how am I reinvesting or redeploying cash into that business or other opportunities? And it's really important that we're aware of what those opportunity costs are, because as Peter Drucker says, there's nothing less valuable than doing something efficiently that shouldn't have been done at all. In other words, you should not start a business and run it well if it shouldn't have been started at all. And again, that's something we can dive into. But for today, what we're really getting into here is we're getting into the capital strategy. So in a world of real estate and inflation, what are some of the things that our clients are thinking about? What are some of the things that we're seeing in the marketplace? And how do those things within our framework inspire us to do things differently, do things, maybe we're doing something that makes sense altogether? That's what we're going to talk about here. All right, so let's get into real estate and inflation perspectives. And I think the place to start first is how we typically experience inflation. I'll go over key drivers here as we work, but to really get a historical picture, I wanted to show this slide, which essentially shows us inflation since we began tracking in the early 20th century. So if you look at early on America, before we really had what we have as the modern Federal Reserve today, we have the early part of the 1900s with very high variable inflation. You can see here that we have increasing deflation, where you have negative percentages during that early 1920s to 1930s period. So a bit of a switch there. And then probably, I think the most other relevant period in the last 50 years would be the 1970s. You can see that circled in the middle. And that's where we experienced what is textbook called stagflation, where we have low growth and high interest rate, not a good place. But also, I think it's interesting that when we talk to a lot of our parents or grandparents about how to spend our money or not spend our money, the big advice we get, at least I will say historical advice, is put it in some kind of a savings account. Don't spend, save. And you can see why. When inflation's that high, what we had were interest rates that were really high up there, it really did make sense to defer spending. And then if you move down the graph to the right, you'll see where we are in 2021, and you'll see a little blip there. We'll talk a little bit about what that means, how meaningful that is. But as you look to the far right of the graph, you'll see that we are experiencing historically high inflation. You might say, well, wait a minute, Miguel, isn't it creeping up there? Is it going to come back to 1970s? We'll talk about that in a second. But it is important that when we look at this graph, if you do narrow it down over the last 10-year period, we've had very low inflation between 1% to 2%. And then all of a sudden, what's happening here in 2021? Are we going off the chart? Are we going back into, Reaganomics, 1970s? We'll talk about that. But if you do look at the data without explaining it or getting into details, it's a 10-year high. It's there. It's the numbers. So we'll react to that a little bit. But before I do that, let me come back to the drivers. And the first thing we want to talk about is interest rates, because obviously interest rates have been at all-time lows. Number one thing we're dealing with in the tax compliance business is I need my tax returns. I'm going to refinance. My mortgage broker says this is the best environment to do it in. Get me my freaking tax return. And as we'll see when we look at the 10-year Treasury notes, you'll see that, during the pandemic, we hit, can't really say I hit zero. We hit zero, but felt like it. The other question I think we should ask in this environment, if we do expect inflation, is, well, is real estate a good hedge? Again, the idea in simplistic terms is going to be that, look, if the price of everything is going to increase, you want to sit on an asset that's going to rise with it. Real estate lends itself to that. But then again, the question is also, are we in a bubble, right? Are real estate prices going up for other demand-centered reasons? And it's kind of circular, because once you get into that, hey, prices are rising because of demand factors. Well, is that inflation then? These prices are going up? I think the big question to ask is how important some of these drivers are, how low interest rates have fed into deals, how, we put out a blog post about how some institutional money is getting into personal homes as well, the residential market, which is pushing up prices as well. Is this big money looking for yield in real estate? And then the last thing is, hey, look, this is a global pandemic that has made remote work the norm. We thought that was never going to happen. And here we are, seeing people decide to live in a completely different area because they can stay with their company, continue to make what they make, and maybe live in a low tax state, or maybe just move to an area where you can get more land. So there are very clearly demand factors that are driving up the price of real estate. Does that make real estate safe in an inflation environment? These are good questions to ask, and we'll get into this in a moment. And then the third, I think, point to look at is going to be stocks. And to talk a little bit about what we're seeing in the stock market, we did bring on our guest, Chris France. We'll get to him in just a minute. But what we have to ask ourselves is stocks a good place in an inflationary environment? We'll come back to whether or not we're seeing inflation, as I know Chris wants to talk about. But if prices are going to go up, and if the cost of milk, the cost of bread is going to increase, does that mean that the dollars in our bank are becoming less valuable? And if they are, what's going to happen to the stock market? Does the stock market rise in an inflationary environment? We'll ask these questions in just a moment. So coming back to the main graphs I was showing earlier, right? Again, the general trends we're talking about is inflation happens. It happens in cycles where you see spikes. It's essentially the repricing, if you will, based on the supply of money. And today we are starting to see that spike. And the one slide I wanted to come back to here is on interest rates. So I was talking earlier about times to refinance. If you look at this graph here in that gray shaded area, that's where we went to what I consider zero. And I want to come back to this and ask Chris about it. So before I do that, though, let me introduce our guest here, Chris France, as our contrarian. So I think, you know, the key points that I'm making here is, if we are in an inflationary environment, it does make sense on the margin to get into an asset class that's going to rise with prices, because, again, coming back to the old anecdotal advice our grandparents gave us, it's not going to work anymore if the value of a dollar is starting to decrease. So what do we do? Do we move into real estate? Do we move into stocks, which the benefits companies can raise their prices in an inflationary environment, and therefore they're, in a sense, a hedge? I'm throwing a lot out, but let me turn this over to Chris, who we have here. And let's start, Chris, with just your thoughts. Are we in an inflationary period?
Hey, Miguel, thanks for having me. Appreciate it. You brought up a lot of good points. And to answer your question right off the bat, inflation's been a very hot topic, really, in the last, 2021, let's say. Weren't really talking about it too much in 2020. And in reality, we've only seen on monthly inflation information kind of sizable uptrends in the last 3 or 4 months. And I'll actually digress and say that, August data is in, I think, as of last week, and then we're already starting to fall back. So jumping into sort of my point there, we have seen about 3 or 4 months of positive, maybe higher than usual inflation growth. And my argument to jump that in is I think it's short term. I think it's basically a reaction to the reopening of, let's just be, country centric here and say America. Remember, we, coming off of lockdowns and shutdowns, and, throughout this year has been a kind of slow, gradual, progressive reopening. And, some of the main sectors that have benefited that clearly were in the gutter, unfortunately, for the last 18 months or so, have been travel and leisure, right? So we're talking hotels, cars, airplanes, that's basically, some of the big ones. So interestingly, about this recent spike in inflation, it's almost completely derived from those four categories. I'm looking at a chart right now. There's used cars, new cars, hotels, car rentals, and airfares. On a typical month over month change in inflation, going back 2 years, which is pre-COVID, so I think kind of a good barometer, we've seen on average a monthly change of anywhere between 5 and 10 basis points in overall CPI. And again, in the last 3 months, 4 months, we've seen a pretty big spike, and we're looking at about 40 to 60 basis points bumps. And those are month over month. So, they're compounding, and that's why you're seeing a big, uptrend in the charts. However, we have Delta, the Delta variant right now. So we had a reopening of America. We had a big boost in travel, and a lot of new money being spent on those sectors. And now, unfortunately, that has fallen off a cliff, completely related to, COVID and the Delta variant. So, had Delta not been so impactful, and had, we had better success in combating COVID-19, then I think that there was a decent chance that some of these particular sectors would have continued to go higher. However, I think we've learned a pretty good lesson over the last couple of months that maybe we're not as far along as we thought we were in fighting this virus. And so everybody has their own opinion and about the time frame of that, but most likely we're going to have a little bit of a cool off in terms of reopening and travel. And of course, some countries and places like Hawaii just announced a ban on or a restricted travel again. So I think it's going to cool off, but again, the majority of this spike, which spike is kind of a generous, aggressive word to say here, is coming from just the reopening of America and some of those particular sectors that have been hot. there's no evidence suggesting that anything else has been relating to widespread inflation.
So if I'm to kind of boil down your perspective, if I'm just to make this like simple for me, we had not a lot of economic activity in these categories. Travel, you're saying auto, and there's obviously some supply chain disruptions when you talk about the semiconductor chip market. I tried to buy a car recently and they told me that they had literally like one car in the Pacific Ocean that they could sell me. So I had to buy a car sight unseen. Didn't do it. But they have one car left. So obviously, like my question, like, hey, any price discount you can give me, like they just laughed at me. They're like, there's one car left, like the price is the price. Take it or leave it. If you don't take it, someone else will. So I certainly see that, but I think, you know, there are some concerns that when you look at how much it costs to buy a house, a car, I mean, if what you're saying is true, then it's temporary. So are we thinking that prices will come back down and normalize in these areas?
That's a good question. Maybe a loaded one at that. So inflation is definitely going to be correlated to asset prices. Jumping ahead, maybe I would say one of the best hedges to inflation is owning these assets, stocks, real estate. Over time, historically, those have been very good hedges to inflation. But I think what we've kind of been through in the last year and a half is different times, unprecedented times. I think that home prices going up as far as they have surprised nearly everybody. And it's not just, you know, Southern California coastal real estate. It's the folks that moved to Dallas, Texas, Austin, Texas, Nashville, Tennessee, Florida, wherever they might have gone. You know, there has been a demand for home prices. I think it also kind of in the beginning, especially correlated to, hey, I live in New York City or San Francisco downtown. I don't want to be in the city anymore. I don't have a reason to be in the city anymore. I'm working from home. I can now, you know, go out there and live on the farm in the suburbs where I wanted to be and have space and have maybe a better quality of life if that's what you're into. That clearly drove home prices over, you know, especially in 2020 and maybe the very beginning of 2021. But Miguel, you raise a good point. You know, how long is that going to go? I think that a lot of the people that wanted to make a move have probably made their move by now. So, you know, one other, you know, maybe factor, in my opinion, is, you know, what is somebody that is has the means to buy whatever kind of asset they want, you know, where are they going to invest today? And I'm talking about maybe somebody that has, you know, several millions of dollars and can, you know, they can go out and buy individual properties. They can certainly buy stocks and bonds and almost any type of private investment that they want. And if I'm a, you know, 70-year-old individual that, you know, typically I've had this, you know, 60-40 allocation to stocks and bonds, and I'm looking at that 10-year treasury, you know, chart, and I'm seeing it at, you know, current day, just it's at about 135 on the 10-year treasury. As Miguel pointed out, you know, we got down to about 40-50 basis points in you know, early 2020. That's directly reflective of the entire bond market and their yields. So if 40 or 50 or 60% of my portfolio, or hey, I'm getting older, I should be more conservative, my portfolio is basically yielding me just a couple of percentage points. Well, you know, looking at that historical bouncing around inflation chart, it doesn't fit the bill anymore, right? So maybe I'm going to go buy that rental property, and, you know, again, I'm in Southern California, so Southern California beach town, and I'm going to buy a rental property for $1 million or $1.5 million, and it's going to cash flow immediately, and it basically subsidizes my lack of excitement in my traditional fixed income portfolio, which has done me extremely well over the last 30 years, going back to the late 70s, when, you know, going back to that inflation chart, you had, you know, 13% inflation, and the 10-year treasury was yielding, you know, I'm just guessing here, but somewhere in the, you know, 15% range or so. Now we're at 1. So, you know, investors have to look to different places to allocate their money. And I think that folks are frankly moving out of the bond market. Stocks are fine. And, you know, if as long as everybody can stomach the volatility, you know, the returns have been there and the data is there to support them. But real estate has been an asset class where folks have definitely been leaning towards.
I mean, I certainly think it's an interesting point that everybody's hungry for return, and whether it's big money or, again, somebody that's just looking to invest. I mean, I think the trend that we're talking about with the whole Robinhood story is that you've got this everyday investor who's jumping into the market and, willing to take a lot of risk, but they're sitting on cash. So I think it is a good point to highlight that these might be blips on the screen. And of course, you always want to look at measurement over time. So I'm curious what this graph ends up looking like if you go back to how it's, CPI index is spiking up for the last few months. I mean, yeah, it could go down as we normalize economic activity. We could also experience an environment where it goes down because Delta is slowing everything down, and then boom, maybe we go gangbusters again, Q1 of 2022 or Q4 of this year. But again, for somebody that's couple $1,000 saving, hustling, maybe $100,000, or the intentions to create that, I don't know, Chris. I mean, are people even looking at bonds anymore? Because what we've seen over the last few years is, I think you were saying earlier that S&P's up, 20% on the year. My house has equity in it that I didn't have a year ago. I think it's gone up like 20%. Probably shouldn't share that, but we're seeing this across the board, and I think people are asking, like, hey, how do I kind of plan for the future in this environment where none of the same rules we're used to apply? So, I mean, I kind of want you to talk a little bit about the bond market. I mean, I might just even throw out, like, do people even care about bonds anymore? And, do we all just park money in the S&P, lock ourselves into the roller coaster, and just let it ride because it's always gone up? What are you telling people, or what should people be thinking about?
Yeah, that's an excellent question, and it's something that I talk about every day with our clients. There's two rules of thought. I mean, you have to. Every client has a risk budget that they're comfortable with, and so you can't go to a very conservative client that's always been conservative. It might have been the way that they grew up. It might have been the fact that they grew up and have been through world wars, and they've seen some stuff. Those clients are probably going to want to hang on to their old ways of doing things, and there's no changing the fact that, hey, you used to get paid 12% a year in this California municipal bond, and now you're getting paid 50 basis points or 0.5%. That's just kind of the environment that we're in. Now, when I'm talking to any younger client, and I know kind of like the Henry's term, right? The high earner, not rich yet, I believe is the right term. Which is a whole bunch of people, right? I mean, there's a lot of folks that have been making good money through this pandemic, and there's a lot of highly educated folks that are doing everything right. And we're wondering, hey, where do you put your money? And you sit there and you say, okay, well, the bond market is, to your point and my point earlier, say unattractive, right? So it's losing its ability at interest rates being so low. The protection's not really there anymore, because if you have a big sell-off, and frankly, we did just about a year and a half ago in March, April of 2020, stock market goes down 30% in 3 or 4 weeks, and the bond market goes down 3 or 4%. So where was the hedge, right? It didn't really work. And then the other purpose of fixed income, not just to be a hedge or a diversifier in a portfolio, is to produce income, right? So going back to the 70-year-old, 80-year-old client that's retired, and they just want to clip their coupons and get a 4 to 5 to 6% return and be very safe and boring as they've been their whole lives, which is a great thing. Safe and boring is what we all want. You can't do it anymore, right? So fixed income is failing. Bonds are failing at both of their traditional sort of offerings. And so what do I tell to the younger clients and the older clients as well that can stomach the risk is, where's money going to go? Money is always flowing, right? Think about one of the biggest Biggest ways that folks save is through their 401k at work, right? So you've got a portion of your check going out every month into, your company sponsored 401k plan, 403b, whatever it might be. And that means you have monthly contributions, kind of usually longer term because it's for your retirement. And you're probably asking yourself, well, why do I need to own bonds? Even if I'm 50 or 60 years old, why do I need to own bonds? And I think that's becoming a real, genuine concern that not just financial advisors like myself, but the regular folks on the street are starting to believe. So I've also seen it on the institutional side when we invest, and I'm sure a whole heck of a lot of you are guys invested into target date retirement funds, like in your 401k might be a target date 2040, and maybe 10 years ago that portfolio might have been 75% stocks and 25% bonds, and maybe now, when you would think that the trajectory would be towards investing more in bonds and less in stocks, it's probably either the same or it's probably higher invested in equities because the outlook is so negative for bonds right now that the returns just might not be there. So I think that you're having a lot of retail and institutional investors, instead of buying bonds, buying equities. And what does that mean? Equity prices go higher, right? It's simply a supply and demand type of a thing. So that's one of my biggest arguments for why am I optimistic about the stock market, not just today and tomorrow, but over the next several years. It's because I don't think people are going to buy bonds. I mean, I know China is still the biggest holder of US treasury bonds, but you know them and a lot of other, let's call them institutional buyers, you know 10%, 5%, those returns were good. They kept the wheels turning for those big institutions that were buying these things. At 1% or less, it doesn't do the trick anymore. So what are they going to do? They're going to buy bonds, and I don't know it off the top of my head, but I would argue that the dividend yield on the S&P 500 is probably like 1.8%. And please don't quote me on that; I could be off. But so you're telling me I get a higher rate of return on the dividends from owning stocks. If I can just forget about any volatility that might come, I'm getting technically a higher income stream from my stocks than I am my bonds. That's why we are leaning towards stocks.
Yeah, certainly. I think for many people today who are in the Henry category, what have we seen over the last five or so years since, or even let's go back to like 2008, right? We were in a world where like, oh my gosh, equities are super risky, right? There's a chance you can use half the value of your 401k, to now, that generation that came out of that, their 401ks have gone, off the charts. If you just look at that growth over the last 3, 4, 5 years, and then, combine that with what we've seen with, silly things like GameStop, there's almost like an emotional sexiness to seeing your money increase. So why would anyone even look at bonds outside of all the right reasons that we've always heard, when you're just not going to get a return? And especially if you look at it for our clients on our side who, are typically, have a W-2, have a 401k, and they're like, I'm going to get an extra, you know, um, you know, 3-2, put it on Airbnb, but I'm going to get a rental real estate investment. I mean, look at what the asset price has done. So it's almost as if, if I look at this past 10 to 5 year period, history within this window has told us that having an income producing asset is a good strategy, good place to park your money. There's tax benefits to it, right? A lot of our, I think, client following is really set on this. And when you look at things like low interest rates, and you look at, how your equities have gone up, it makes it really easy to just take a loan out against your 401k, cash some of that out, get a low interest loan, and go out and buy a real estate asset. And okay, we're saying, hey, this inflation might not be real, but it does seem like on the margin, it's a pretty good strategy to write out real estate. I think the question that I think we'll just leave the listener with, the clients with here on this call is, are any of these in a bubble environment? So are any of these asset classes, if you will, real estate or stocks, in an asset bubble? And if I pick on something that you were saying, Chris, with the stocks, it's, hey, money's going to continue to buy equities. So what's the price of a stock? Whatever someone's willing to pay for it. And if there's consistently a buyer and money flowing into equities, then when is it a bad bet? You know, it kind of gets into that whole craps analogy. When do you stop rolling the dice? You don't, right? Because you continue to make money. So I think, where we'll leave that question is, I think if you are to look at the underlying economics, and the sense is, hey, this is not a bubble that's going to burst anytime soon, and there might be inflation, it almost kind of suggests that don't change your strategy, right? It's going to be real estate and equities all the way. So we are at time. Chris, I want to thank you for joining, and thanks for being a part of this call. We are going to wrap it there. We'll finish on a question slide. So if you do have questions, feel free to reach out to us. You can reach out to your tax manager or Sean, and we can coordinate that. Going back to the announcements, we are starting to schedule our Q4 meeting. So with that, I want to thank everyone for joining this call. Thanks, Chris. Thanks, Sean. Have a good rest of your day. Hopefully we learned something.